The market's just closed, but what happens over the next 72 hours? It could be the most significant weekend in silver market history, and guess what? No one's talking about it. You're about to hear something that could change the way you view silver, fast. My name doesn't matter, but my access does. For the past 12 years, I've been a private commodities analyst. And while most people wait for Monday morning headlines, I've got something better. Data feeds that most retail investors don't even know exist. And right now, those feeds are screaming something loud and clear, something that the mainstream financial media has missed. Here's what they're not telling you. So here's the situation. The U.S. markets didn't just close for the weekend. They're closed for 72 hours. That's 3 full days. Why? Because Monday is Martin Luther King Jr. Day, a federal holiday. The New York Stock Exchange, NASDAQ, the COMEX, they're all dark until Tuesday morning at 9:30 a.m. Eastern. Now, in a normal market, a long weekend is just that, a break. Traders step away and nothing happens. But we're not in a normal market. We're in a market where silver just hit $92.25, an all-time record high just 4 days ago, a market where the Shanghai premium is sitting at double digits, and where traders are doing something I've never seen before. They're rolling contracts backward, not forward, and that matters more than you think. But here's where it gets crazy. When the markets close for 72 hours, it's not just a pause. The physical market doesn't sleep. And while the U.S. is offline Asia, they're still trading. And they're not playing by the same rules. So why does this matter to you? Here's the big question. What happens when the paper market, the one that sets the benchmark price, goes offline, but the physical market keeps running, discovering prices, executing deliveries? Now let's talk about the data that should be making your eyes widen. On January 7th, something very unusual appeared in the COMEX open interest data. Open interest is simply the total number of futures contracts still active, those that haven't been closed out or settled. Normally, as we approach contract expiration, traders roll their positions forward. They close out the January contract and open a March contract. Standard procedure, right? Except on January 7th, the data told a completely different story. January open interest increased by over 1,000 contracts. February open interest jumped by 1,564 contracts. But here's the kicker. March open interest dropped by nearly 2,800 contracts. This wasn't traders rolling forward. This was traders rolling backward. They were moving their positions from March, a major delivery month, back into January and February, minor months. Why? Simple. They want delivery sooner. They don't trust they'll get metal in March. They're willing to pay the cost to get it now, not later. And then on January 8th, we saw confirmation. 1,124 January contracts were standing for delivery. That's over 8 million ounces of silver that traders demanded in a minor delivery month. Now, here's where it gets uncomfortable. JP Morgan issued 99% of those deliveries. One bank delivering 99% of the metal to multiple receivers. Now, let's put this into perspective. The COMEX registered inventory, the actual silver available for delivery, sits at about 127 million ounces. That sounds like a lot, right? But when you start seeing 8 million ounce delivery days in a minor month, the math doesn't add up. If this keeps up, that inventory could be drained in weeks, not months. And this is the setup we walk into during the 72-hour blackout. While New York is dark, Shanghai, they're open for business. But Shanghai isn't a paper market like the COMEX. It's a physical delivery market. When someone buys silver on the Shanghai Gold Exchange or the Shanghai Futures Exchange, they're buying metal. Metal that gets delivered into Chinese warehouses. And with the new export licensing rules that went into effect on January 1st, that metal can't leave China. So here's the reality. For 72 hours, the only price discovery happening for silver will be in markets that favor physical over paper. Markets where the premium to COMEX is already at $10 or more. Markets where industrial buyers, the ones who need silver for solar panels, electronics, and electric vehicles, are competing with investors for every available ounce. And as Shanghai bids up the price, New York will be asleep. So imagine this. On Monday, while New York is in blackout mode, Shanghai continues to trade. And if the premium to COMEX widens, let's say to $12 or even $15, the gap could be massive by the time the U.S. markets open on Tuesday morning. Now, here's where the pressure builds. When the markets finally reopen, arbitrage traders will face a tough choice. Do they buy in New York and try to ship that silver to Shanghai to capture the spread? That could take weeks. And right now, there's no guarantee there will even be enough metal available. Or do they let the COMEX price gap up to match the price being set in the East? Either way, this spells disaster for the paper market. If they ship metal, Western vaults drain faster than ever. If they let the price gap up, it destroys the illusion that the COMEX price is the true price. And here's why this is so critical. This is not some hypothetical situation. This is already happening. The Shanghai premium started at $5 in early January, then grew to $7 last week. This week, it hit $10. And every time the COMEX tries to push the price down with low volume overnight selling, the Shanghai premium just keeps widening. The East is no longer accepting the Western price. The East is setting its own price. And that price? It's higher. Now, I know what some of you are probably thinking. A 72-hour closure isn't that unusual, right? Markets close for holidays all the time. Nothing dramatic happens, and you'd be right if we were in a normal market. But this is anything but normal. We're not in a balanced market. We're in the 5th consecutive year of structural silver deficits. Global silver production is around 820 million ounces per year. But global demand, that's over 1.2 billion ounces. The gap between supply and demand has been filled by drawing down above-ground stockpiles. But guess what? Those stockpiles are running low. Take the LBMA, the London Bullion Market Association, which used to hold massive silver inventories. Over the past year, they've seen consistent outflows. The COMEX registered inventory, it's at multi-year lows. The SLV ETF, supposed to hold physical silver to back its shares, it's seeing redemptions as investors pull metal out and store it privately. And here's the kicker. China has effectively sealed off its silver supply. The export licensing rules that went into effect January 1st mean refined silver in China stays in China, no silver leaves. That's 65% of the global refined silver supply locked up way in China. So when I tell you this 72-hour closure could be significant, I'm not just hyping it, I'm reading the data. The supply is tightening, demand is rising. The price gap between East and West, it's only getting wider. Let's step back for a moment and consider this from your perspective. What does this mean for you, the individual investor? Because if you're anything like most people, you're watching this unfold and wondering how it all affects you. Well, here's the harsh truth. The silver market is no longer just about institutional players. It's about real people like you who are getting caught in the crossfire of rising demand, shrinking supply, and massive price volatility. Retail demand is surging. But when physical silver becomes harder to find, it's not just the big players who are feeling the squeeze. You are too. If you've been trying to get your hands on physical silver, you've probably already noticed the premiums are spiking, prices are climbing faster than expected, and availability is shrinking. This is no longer an isolated issue. It's a growing crisis that's impacting ordinary people who are trying to protect their wealth, their savings, and their future. If this feels familiar, say so in the comments. Let's talk about how this is changing your reality. But here's the big question. What happens when the pressure keeps building? When those premiums get so high that buying silver at any price becomes unsustainable? What happens when the system starts to break? Now, let's take a step back and look at the bigger picture. This isn't just about silver. This is about the system that makes all of this possible. And if you understand the mechanism at play, you'll realize how deep the problem goes. The reason this is happening, the reason the prices are diverging, the reason inventories are draining isn't just supply and demand. It's about leverage, incentives, and fear. You see, the physical market is doing one thing. It's forcing the paper market to catch up. The East, with its focus on physical delivery, is saying loud and clear, the price you're setting on paper doesn't match reality. And here's the unsettling part. The more pressure the physical market puts on the paper market, the more those in control will scramble to protect the illusion. They'll do whatever it takes to keep the system from breaking. But in doing so, they risk undermining the very credibility of the paper markets that have governed this space for decades. It's leverage at its finest. The physical market has the power right now, and that power is shifting the dynamics of global price discovery. And here's the kicker. The longer this continues, the harder it will be for the West to catch up. Now, let's talk about what happens next. The truth is, there are two possible paths forward, and neither one is certain. First, you've got the path where the price gap between East and West continues to widen. If the Shanghai market keeps bidding up the price and COMEX refuses to follow suit, we could see an unraveling of the paper market. The price in New York could gap up, reflecting the price in Asia. If that happens, the illusion that the paper market sets the true price will be shattered. We're already seeing the cracks, and it could be just a matter of time before the floodgates open. But there's also the second path, the possibility of intervention. The Western markets may not just sit back and let this happen. We could see margin hikes, new position limits, or even rule changes designed to protect the system from collapsing. If that happens, it may offer a temporary fix, but it won't solve the underlying issue. The paper market is losing control. One thing's for sure, the next few days will set the stage for the coming months. And what happens when the markets reopen on Tuesday morning could very well be the moment that defines where this market goes from here. So here's the bottom line. The 72-hour blackout isn't just a long weekend. It's a window into a future where the East sets the price and the West plays catch up. The silver market is at a crossroads. The pressure is mounting and the system is showing signs of strain. When the COMEX reopens on Tuesday morning, it'll tell us whether the paper market can hold its ground or if it will collapse under the weight of physical demand. Whether we see prices gap up or some kind of intervention, it'll reveal something crucial about the health of the system. And while the media will try to frame whatever happens as either a bubble bursting or a healthy correction, don't be fooled. They're just chasing clicks, not the truth. The truth is, we're in uncharted territory, and what happens next could reshape the silver market and your future forever. So don't panic, don't make emotional decisions, but also don't ignore what's happening. The backward rolling, the backwardation, the Shanghai premium, the vault drain, these are all signals. The market is telling you that something is changing. If you've been waiting for a sign that the silver market is entering a new phase, this might be it. Stay sharp, trust the physical, and make sure you're ready for what comes next.